In the depths of the cryptocurrency ocean, massive creatures lurk in the shadows capable of creating tsunamis with a single movement. And these aren't mythical beasts, they're crypto whales. And they control more wealth than entire nations. Welcome to the SwapSpace channel. Today, we're diving deep into the world of crypto whales to uncover the shocking truth about how a handful of individuals and institutions can manipulate billions of dollars with the click of a button. And speaking of clicking buttons, don't forget to click the like, comment, and subscribe buttons to support us so we can keep bringing you the best crypto content every week. So, what exactly is a crypto whale? In the traditional sense, a whale is someone who holds massive amounts of cryptocurrency, typically 1,000 Bitcoin or more, or equivalent values in other cryptocurrencies. The definition has evolved significantly since the early days.
Fin whales, sei whales, and humpback whales.
Let's put this into perspective. As of 2025, there are approximately 2,000 addresses holding more than 1,000 Bitcoin each. These addresses collectively control over 40% of all Bitcoin in circulation. That's nearly $1 trillion in today's market, sitting in just over 1,000 wallets. Makes you wonder if the 51% attack could possibly happen. In theory, of course.
Well, theoretically, yes.
But whales aren't just individual crypto millionaires. We have several categories. First, the OG whales, early adopters like the mysterious Satoshi Nakamoto, who still holds nearly 1 million Bitcoin untouched. Then we have corporate whales like MicroStrategy, who holds over 600,000 Bitcoin, approximately worth $43 billion as of July 2025. We also have institutional whales, hedge funds, family offices, and even entire countries like El Salvador. Each category operates differently, but they all share one thing: the power to move markets with their decisions. Let's meet the titans of the crypto world. At the top of the food chain, we have Satoshi Nakamoto, the enigmatic creator of Bitcoin who holds nearly 1 million BTC, making them potentially the richest person on Earth if they ever decided to cash out.
But now I can't use it.
And the new apex predator that has been quietly accumulating massive positions, BlackRock. Through their iShares Bitcoin Trust ETF, BlackRock has become one of the largest institutional holders of Bitcoin with over 740,000 Bitcoin as of August 2025. That's worth approximately $53 billion at its current price.
It's making too much money.
Looking at their recent purchase history, we can see the methodical approach of a true institutional whale. In just the past few weeks, they've added over 4,000 Bitcoin in a single day on August 8th, followed by steady accumulation of hundreds of Bitcoin daily. Then there's Michael Saylor and MicroStrategy, the corporate whale that shocked the world by going all in on Bitcoin. Not only does Saylor personally own over 17,000 Bitcoin, but his company accumulated 600,000 Bitcoin, making them the largest corporate holder of cryptocurrency.
All in.
But here's where it gets interesting. Some of the largest whale addresses actually belong to cryptocurrency exchanges. Binance, Coinbase, and other major platforms hold millions of Bitcoin and Ethereum in their cold storage wallets. Recent data shows Binance whales' inflows surged by $1.5 billion, indicating massive institutional movements behind the scenes. And let's not forget government whales. The US government holds over 200,000 Bitcoin seized from various criminal activities, making Uncle Sam one of the biggest whales in the ocean. When they decide to auction these coins, the entire market pays attention. Now, here's where things get dark. Whales don't just hold crypto, they actively manipulate markets using sophisticated strategies that would make Wall Street traders jealous. One of their favorite tactics is spoofing, placing massive buy or sell orders with no intention of executing them, just to create a false impression of demand or supply.
Oh, it's a false demand.
Imagine seeing a 10,000 Bitcoin buy order appear on the books. Other traders think, someone knows something I don't, and they start buying, driving the price up. Then, just before execution, the whale cancels the order and sells into the artificial pump they created.
He can't keep getting away with it!
Then there's the wash trading, where whales simultaneously buy and sell the same asset to create the illusion of market activity.
Illusion.
This artificial volume makes it appear that there's genuine interest in the cryptocurrency, attracting retail investors who think they're seeing organic growth.
If I'm to invest, I'll need to know the story.
The MITRE-ADAPT framework specifically identifies this as a key manipulation technique where adversaries create false market activity. Perhaps the most ruthless tactic is stop-loss hunting. Whales analyze where retail traders typically place their stop-losses, then deliberately crash the price to trigger these orders, causing a cascade of selling. Then they buy back at the bottom, having essentially stolen money from small traders. During bear raids, Whales coordinate aggressive selling while spreading fear, uncertainty, and doubt through social media and news outlets. Check out our video on FOMO and FUD to better understand these phenomenons in crypto.
You should really check out this video.
Now, a bear raid is a deliberate strategy to drive down asset prices through aggressive selling and psychological warfare. They drive prices down deliberately, then accumulate massive positions at discounted prices before allowing the market to recover. There's also the practice of painting the tape, executing trades at specific times to create artificial patterns that trigger algorithmic trading systems. Whales know that many retail traders rely on technical analysis, so they create false breakouts and breakdowns to trap these traders in losing positions. Let me show you real examples that will blow your mind. Remember the May 2021 Bitcoin crash from $64,000 to $30,000? While Elon Musk's Tesla announcement got the headlines, on-chain analysis revealed that several whale addresses moved over 50,000 Bitcoin to exchanges just hours before the crash, suggesting they knew what was coming. More recently, in 2025, we've seen MicroStrategy's 10,000 Bitcoin outflow coincide with major market movements. When institutional whales like MicroStrategy move coins, it sends shockwaves through the entire ecosystem, often triggering algorithmic trading bots and retail panic, which could partially be the reason for Bitcoin hitting all-time high records in summer of 2025. Even more telling are the exchange whale movements. When we see massive inflows to exchanges like Binance, such as the recent 1.5 billion surge, it often precedes major market volatility. These movements are likely early warning signals for those who know how to read them. But Bitcoin isn't the only target. Smaller altcoins are even more susceptible to whale manipulation, and a single whale holding 10% of a token supply can create 500% pumps overnight, then dump on unsuspecting retail investors who think they've found the next big thing. Worst case scenario, you get what we call a rug pull. Click the link above to watch our video on some of the most infamous rug pulls in history. Here's a textbook rug pull. Consider the case of a lesser-known altcoin where one whale controlled 15% of the total supply.
You hate him.
I hate him.
Over the course of 3 months, they systematically pumped the price by 800% through coordinated buying and social media campaigns, only to dump their entire position in a single day, crashing the price by over 90% and leaving thousands of retail investors holding worthless bags.
You can't keep getting away with it!
Now, here's something to bring your hopes up. The Swap Space channel giveaway. You can be one of 3 lucky winners of $20 just from watching this video. To enter, like this video, comment below what kind of whale you think you would be if you had 10,000 Bitcoin, and subscribe to our channel for more awesome content like this every week. Good luck. So, how do we track these digital leviathans? Professional traders use sophisticated tools like Whale Alert, which monitors large transactions in real time, sending notifications when whales move significant amounts. Advanced platforms like CryptoQuant provide deep insights into whale behavior, tracking dormant addresses that suddenly become active, identifying exchange flows, and even clustering addresses that likely belong to the same entity. Other sophisticated tools include Sentiment, which tracks and analyzes blockchain activity, allowing users to monitor on-chain analysis for Bitcoin and Ethereum. But it's not just about the blockchain. Savvy analysts also monitor social media, looking for coordinated messaging campaigns that often accompany whale manipulation attempts. When hundreds of accounts suddenly start promoting the same narrative, it's often a sign that the whales are preparing to move. The most advanced whale tracking involves cross-referencing multiple data sources, on-chain movements, exchange flows, derivatives positioning, and even traditional financial market indicators. Some professional trading firms often deploy teams of analysts whose sole job is to decode whale behavior patterns. Understanding whale psychology is crucial to predicting their next move. Unlike retail investors who trade on emotion, whales operate with calculated precision. They think in terms of quarters and years, not minutes and hours.
Step up your game, Scott.
Whales often use a strategy called accumulation in silence, slowly building positions over months without causing significant price movement. They break large orders into thousands of smaller ones, spread across multiple exchanges and time periods. They also employ sophisticated risk management techniques. While a retail investor might go all in on a single trade, whales diversify across multiple assets, use complex derivative strategies, and always maintain significant cash reserves for opportunities. Perhaps most importantly, whales understand market psychology better than anyone. They know that retail investors are driven by fear and greed, and they position themselves to profit from these emotions. When retail investors are most fearful, whales are buying. When retail investors are most greedy, whales are selling. So what does all this mean for the average crypto investor? First, Understand that you're not just trading against other retail investors, you're swimming with whales who have resources, information, and strategies that you don't. The market isn't always fair, and the price movements aren't always organic. By understanding whale behavior, tracking their movements, and recognizing manipulation patterns, you can avoid being their prey and potentially profit alongside them. The key is patience, education, and never risking more than you can afford to lose. Because in this digital ocean, the whales will always be bigger, but that doesn't mean you can't survive and thrive alongside them.